how to select the best cities for your real estate investing. That's today's episode. Let's dive into it.
Here we are at our very first rental property.
Hey everyone, I'm Clayton Morris, longtime real estate investor, and welcome to the Investing in Real Estate Show. This is the show where we hope to help you build financial intelligence. This is the stuff you were not taught in high school. If you were, I would love to know the name of your high school because I would promote the name of that high school all over the world and everyone should go there. But this is the place where people don't know about financial resources. They do not understand financial independence. They don't understand all of the things that go into it. And we focus on buy and hold real estate. That's what we focus here on the show all about. And if you want to download our free cheat sheet on how to figure out your financial freedom number, you can just go to morrisinvest.com/freedom, or the link will be in the description below. It's a 3-page PDF that can help you on your way to figuring out how much are your monthly expenses and how do we reverse engineer that to build financial freedom with real estate. I have a great guest on the show today. He is affectionately known by his friends as the mad scientist of multifamily. He's a technologist, somebody after my own heart, and an entrepreneur in love with the power of numbers to create profit for his real estate investors. He's the CEO and founder at Grow Capitus, which is a commercial real estate investment company. He's worked with over 300 investors. He has over 1,800 units himself. He is an expert. He is Neil Bawa, and he joins us today on the show. Neil, great to see you.
Thanks so much for having me on the show. I'm very excited to be here.
Well, I'm thrilled to have you here, and we had some makeshift digs this week. Normally, we would be in our normal studio, traveling. I'm a little sick, so thank you for playing along. I said, I want you just to do all the talking today. Is that cool with you?
Absolutely. I'm happy to do that.
Perfect. So let's wind the clock back a little bit. Take me back to how you got started in real estate investing. Paint a picture for our audience about who you are and how you grew to be a real estate expert.
Sounds good. So as I mentioned, I'm a technologist, successful tech career, successful tech exit. And even before that successful exit, I was a partner in my firm and was paying taxes like crazy. So like a lot of technologists, I got into real estate for tax avoidance and tax deferment. And what I was lucky with, Clayton, was that in my day job, right, as a technologist, I actually got into real estate in reverse. So most people do, single family rental, then they buy a duplex, then they buy something bigger than that. My first experience in real estate was helping my CEO, brilliant guy, with a $4.5 million campus, 27,000 square foot new build construction. Right? And we're building this for students. So imagine the difficulties of having egress and, body count in every single room and air conditioning and heating issues and fire issues. It was an absolute drinking from a fire hose for 9 straight months. And I learned incredible amounts about real estate. And I had a great mentor. His name's Paul Afshar, taught me a lot. And building that campus allowed me to see what real estate can do for a company, right? So we went from having a ugly, small rental space to having a beautiful campus of our own. And our brand developed so much that in 2 years, I ran out of space in this 27,000 square foot campus and had to build a new one. It was next to us, and it was a building that was 50% more. And we didn't have the money to basically buy that building outright and repeat the whole process. So this time what we did was, once again, with help from my CEO, we went and sold the concept of joint investing to a bunch of doctors. This is in Fremont, California, the home of Tesla Motors. And so we go to these doctors and we basically say, we're going to buy this 33,000 square foot building, and it's an empty shell, and we are going to build it for you for free. And we're going to chop it up, condominiumize into 2,000 square foot spaces, and everybody gets to have their own space in their name, and then we'll rent it back from you. Because we're a growing business. We want to rent it back from you. And we were like, nobody is going to believe in this nonsense. In about an hour, we had $3.5 million. And you know why? Because, Clayton, what I didn't understand was I was supposed to be charging for this service, right? The standard developer fee for a $6 million project is 5%. So we should have charged $300,000. We didn't. We didn't know any of these things. I had just done a syndication, broken every possible rule in syndications, didn't even know that for the next 3 years because I didn't learn the term syndication until 3 years later, right? So for me, this was just great. It was like, oh, all these people are giving me money to help me grow my business. Oh, it's so awesome. What I realized was I was giving them money, right?
Wow. When did you realize that? When did you realize that snafu?
to me, basically, the first year was just, okay, let's build this campus, and we built it, and we did the 2,000 square foot, spaces, and rented it back from everybody. It's after I started paying rent to them, I was like, these guys got a really good deal. Do other people get these kinds of deals? And I started researching on the web, and I was like, oh, yeah, people do these things called syndication where they buy a $20 million multifamily and everybody pitches in and puts money in. But then I realized, oh, people are charging 30% split plus, an acquisition and a developer fee, 5% developer fee to do this. And I was like, I didn't charge any money to do this. And I was like, oh, people can make money like this. So I was like, oh, this is great, because 12 years later, Clayton, every one of those suites is still rented back to that business that I've already sold, right? So these doctors got the deal of their lifetime. Somebody came in, built something, and even found a tenant for them, and they did nothing, right? That's how good it was for them. And I was like, I need to do more of this for myself, for my money, right? Luckily, I own one of the suites, so I did get benefits from that personally. And so that took me into real estate. That was like, I need to do real estate. And the mistake I made, Clayton, is I should have gone straight away into commercial real estate, because I knew I had skills. I had built 60,000 square feet from scratch, which most people in real estate don't know how to do. I chickened out. I went into single family, right? I bought 10 single families in California, which I still own. Then I bought 10 triplexes in Chicago. And I absolutely loved the scale of that in Chicago, and I absolutely hated the tenant base. So the things I'm going to tell you about, how to buy in the right cities and neighborhoods today is all based on this incredibly bad tenant base that I had in South Chicago. I learned a humongous amount from that experience. And then what I did was I went into syndications. I invested in 13 passive syndications. I helped those syndicators market their properties. This was 2010, 11, and those properties were doing poorly. I was an internet marketing expert because I had 30, 40 units of my own. And so I helped them market, and then they taught a lot of things to me, and I started teaching those things using a meetup that I built inside of my business. Remember, it was a college, right? I had this beautiful campus that I just built. I had all these classrooms and projectors and whiteboards and internet access. So I built a meetup there, and that meetup, along with some other partners, became one of the largest in the United States. And that basically started the process of me transitioning into real estate. 2013 was when that business was sold, and I transitioned after that. And since then, it's just snowballed. I mean, we now have 1,200 investors that are registered on our platform. We've invested $40 million of their money to buy $150 million of real estate. So gradual transition from 2003 to, basically a decade later. But it was a fantastic learning journey.
Well, yeah, and it sounds like you wouldn't. I mean, you could go back and make a little bit more money and offer up this platform and offer up these offices to these doctors and say, I'm bringing you these great deals. I could have made a little bit more money here because that's normal. When you're the one bringing the deal, then you also can add that money on top, and that's how a lot of these syndicators will make money. If you had to go back and do it all over again, would you have charged them more for that, or was this a great learning opportunity for you?
No, I think because if I had charged them, the expectations would have been different. I didn't have the P&L statements. I didn't have the monthly updates. They just knew that my boss and we were working really hard at it. And so I think that, no, I wouldn't have changed anything. What's interesting is all of those people now invest with me. So in a way, I did receive my benefit. I just didn't get it then. Right. And the other benefit that I got was that second building, we filled it up with students, and it allowed us to exit at class leading, multiples for our business. So I did make millions of dollars from that building. I just didn't make it directly.
Right. The universe has a funny way of providing for you on the backside of that. That's great. So, I'm a single family guy. I own some multifamilies, but single families is where I cut my teeth. It's what I, continue to buy. It's how I was able to achieve financial freedom. So that's been my focus. I do have some multifamilies, but you made the switch. You were doing these large projects. I mean, massive projects, a campus, for crying out loud. I can't imagine that. And then you jump into single families. What was the thought process behind that? Why, you said you wimped out. Why did you think you wimped out?
Well, I think it's because when you're doing these kinds of things, you're thinking, do I know enough to do this professionally? I did it for my business. I was supported by my business. When I did it, I didn't know for sure whether it would be successful. And so I think what basically for me, what I did there was that I said, I think I'm good enough to play with this, but I still need to learn more on the single family side. And the metrics I'm going to give you today are really single family metrics because I learned them through all of my single family investment. They apply to multifamily. I mean, but they apply to multifamily 90% of the time, where they apply to single family 100% of the time.
Great. So let's dive into it. So the theme of this episode today is the best markets, the best cities to invest in. It's a question we get a lot here on the show. And I'd love to, first of all, just at a high level, where do you start your research at a 30,000 foot level? How do you begin to approach this question?
I use two sites. Just two sites is all I need. One is Google, so that's easy. And the other one is city-data.com, right? So between these two sites, I'm able to figure out the best cities. I'm going to give you 5 metrics that are going to allow you to pick great cities in the United States to invest in. 5 metrics, right? So number 1 is population growth. Go into a city that has strong population growth, and I'll tell you how much in a minute. Second, make sure that the median household income in that city is going up, and it's going up faster than inflation, or at least as fast as inflation. Number 3, that those two things, if you've got population growth and you've got median household income growth, it's going to lead to the third, which is an increase in home prices. So make sure that that increase in home prices is happening. The fourth is that if all 3 of those things are happening, crime levels are going to decline, because crime levels are inversely proportional with these 3 things. And then the fifth one, the big one, is jobs. That city has to have very strong job growth.
Perfect. Okay, great. So thank you for those 5. Now let's dive into some of the ranges here. And what are we looking for? What numbers are we looking for? So do you want to go through each of the 5, or do you want to give us some broad strokes? Okay.
Yeah, I'm going to give you each one of those 5. So let's talk about population growth, right? Most cities in the United States that people invest in, 80%, 90% of them, are between 250,000 and 1 million. We're not talking metros, we're talking cities, right? For those cities, you roughly want a 1% population growth per year. So that's the easy metric to use. But if you want a very detailed metric, between the year 2000 and the year 2017, so that's 17 years, you want there to be 20% growth, so a little bit more than 1%. Now, how do you find this out? Well, just type in population growth, Columbus, Ohio, or population growth, Detroit, Michigan, and Google will give you those 2 years. It'll give you the year 2000, it'll give you the year 2017. Just match up the difference between the two. You want it to be 20% or more. That's the right amount of population growth. So roughly 1.25% a year for the vast majority of cities. If a city is bigger than that, you can be a little lower. If the city is smaller than 250,000, let's say a city of 50,000, then you want it to be faster than that number.
How do you account for, we had a big recession, right? We had a lot of cities that had a lot of big problems. How do you account for that 2007, 2008 era? Is that just an outlier, or has that become part of that data for you?
So it's, on the job growth side, there was a major shift in between 2008 and 2010. From a population side, there wasn't. So I've already factored that into my numbers, right? If 2008 to 10 didn't happen, we wouldn't have seen a difference in population growth, right? Population grows anyway, whether people are employed or not. We only saw a very small decline in birth rates during those 3 years. So this particular factor, 2008, doesn't matter.
Okay, perfect. All right. So number 2 on the list.
Yeah, let's move on to the number 2. So we talked about population growth being 20%. Now, in that same time frame, right, 2000 to 2017, and you can figure this out using a website called city-data.com. Go in, type in your city, let's say Columbus, Ohio. Right at the top of the page, you'll see median household income. Make sure that between the two years that City Data mentions, it's going to say 2000, it's going to say 2016. It's not going to say 17, so there's a slight difference between the first metric and the second one. Those 16 years, you want to make sure that the median household income in that city grew by 30%. 20% for population, 30% for income.
Why
right?
30? Why 30 to you?
So because what we found, again, back testing, right? Because you want to grow significantly faster than inflation, or at least at inflation levels. At 20%, you're not growing at inflation. You're growing slower than inflation. So you're actually losing money by investing in that city, right? Once you're at 30%, you're growing at inflation. Because if you look at inflation over those 16 years, it was roughly 30%, maybe a little bit lower. So you're gaining just a tad bit from an inflation perspective when you're hitting that 30% level. If you're not hitting 30%, you're deluding yourself into thinking, oh, this city has income increases. No, it doesn't. After adjusting for inflation, it has income declines. Its purchasing power is going down. Therefore, 30% is that magic number for your median household income.
Great.
All right, that's
Great
number
stuff.
2. Number 3, if you've got both of these two things happening, guess what happens? It leads to home price increases. So on the same page, right below median household income is median condo or home value. Well, those two numbers, you'll again see two numbers, match them up. They've got to be up by 40%. A 20% population increase drives a 30% income growth, which drives a 40% growth in home prices. And in some cities like Orlando, you're going to see a 100% increase. Phoenix, you're going to see a 100% increase. Vegas. So, but you want to see a minimum of that 40% increase because you want to make sure that this city is not being left behind as the country grows.
When you have that 40%, or you see like Orlando at 100%. I used to live in Orlando, so I know the craziness of that area. Vegas, of course. Are any of those numbers indicative of a bubble to you that should be concerning? You see 100%, 150%. Is that something you might then also on the other side of it avoid because it's just too much?
Absolutely. I want you to ask me that question after I finish the fifth one,
Okay.
and I'll give you a specific bubble meter if you want one.
Perfect.
All right.
Perfect. I was one
So
step
number
ahead.
4 is crime. On the same page, there's a crime table. It's a big crime table. You can ignore all of it. Just go to the bottom line. On the bottom line for the most current year, you want to see a crime number of under 500. So that's the simplest way to tell it to you. Under 500 and declining. So you'll see lots of years. You want to make sure that the numbers on the left, which are previous years, are higher than the numbers for the current year. So that means crime is declining. Do not go into cities where crime is increasing. And then the fifth number is jobs. So you got to go to a website called departmentofnumbers.com/employment/metros. This one, I don't have an easy link for you. departmentofnumbers.com/employment/metros. You will then see every city in America. And this is the only number that's current. All the others are 1 to 2 years old, which is fine. But these numbers are always 1 to 2 months old because of Social Security checks having to be cut. So the government is always up to date on job data in the United States. Go in there and make sure that the city that you're investing in is above 2% in job growth. 2%. Now, if it's a really big city like Los Angeles, 1.5% is fine. But in that Goldilocks zone of 250,000 to 1 million person cities, be at 2% or higher. If you use these 5 numbers, just these 5 numbers, it'll take you no more than 10 minutes to do this for one city. You are in the top 1% of investors in the U.S. because the vast majority of investors in the U.S. don't know how to do this kind of filtering.
That's great. And that's why it takes our team 6 to 7 months before we move into a new city with all of the data and everything that we're polling and everything that we're looking at before we're investing in those areas. So really, really smart stuff, Neil. So let's go back to the bubble question here, which is looking at something going wild on the other side. We mentioned Orlando, we mentioned Vegas, something hitting 150%, 200% property value increases. Where do you get concerned that those numbers are out of whack for you?
Short answer is something known as the income price. Everything I just gave you is free, right? So it's on the internet. You should be able to do it right away. But at some point, if you really, worry about bubble data, you've got to pay a little bit. So there's 2 or 3 different ways to get bubble data, and one is the cheapest and the fastest and the easiest way is Local Market Monitor. So go to localmarketmonitor.com and buy a subscription. Some of the subscriptions they have are very inexpensive. Let's say you're looking for Texas or Florida. Just buy the subscription for that area because you may not be looking at the entire United States. Even if you're looking at the U.S., we have a discount code with them that drops half of the price called Multifamily U. Just the word multifamily followed by the letter U, they give you a huge discount. So go to localmarketmonitor.com and look at something known as the income price. It is perfectly okay, Clayton, for prices to double in a city where incomes are increasing very fast. It's perfectly fine. It is not okay for prices to even go up 30% in a city where incomes are not increasing. So the percentage doesn't matter. Denver, for example, is a bubble at this point because the fastest increases since the recession have been in the city of Denver, right? So real estate has more than doubled. Now, incomes in Denver have gone up much faster than most cities in the US, but home prices have gone up so much that Denver is considered a bubble. In Local Market Monitor, and by the way, you can find some of this information if you want to get it for free. The founder of Local Market Monitor did a webinar for us where he actually showed off the income prices for 25 cities. So you can go look at that one. It's recorded on my website, multifamilyu.com. So you can get that for free, but keep in mind it's not current data. It's 6 months old. So if you want current data, go to their website, sign up, pay a few $100, and look at something known as the income price. What they say, which I truly believe in it, is you don't want more than a 20% gap between the price that people can really afford, the income price, and today's price. Because above that 20% is where bubbles develop. And you'd be surprised to hear that there are some cities that you'd think are in a bubble, like Los Angeles, that are not. Because at this point in LA, properties are 19% above the income price, and a 20% range is considered very normal. Even 25 is okay. It's when you start hitting prices 25% or higher than the income price, the affordable price, that is when a bubble develops. So it doesn't matter how much prices have gone up in the last 10 years. They just shouldn't go too far above the income price. So there are areas in San Francisco, for example, is way above income price at this point in time. Denver's the worst. Seattle's up there. So there's a lot of cities, smaller cities that where the income price is really, really high. Nashville is up there. Dallas is getting there. So Dallas is at 25% above. But there are many cities that are 30%, 35%. Orlando, you mentioned, it's getting to that point. It's at about 24, 25% above income price. So watch those prices. Because in 2019, if you're going into a city that is 30% above income price, the bubble has already developed. Doesn't mean that it's going to burst, but it might take a year to burst or 2 years. But that city is now a bubble city. So you are going in knowing a bubble has developed. Well, if you're not doing that, then obviously you're not an investor, you're a speculator.
Right. And my audience certainly knows how I feel about speculation. Neil, I got to say, we're going to have you back. Let's have you back real soon. Let's do another episode where we talk about, market conditions. Where do you see things going? We'll analyze. We'll talk bubbles. We'll talk affordable housing. We'll talk rent control, which has been all over the news recently. And we'll talk about all of those indicators. This has been amazing stuff, Neil. I really want to thank you for this and sharing this with our audience. You've made our audience more intelligent today, and that's what we aim to do here on the show. How can people connect with you? You mentioned multifamilyu.com. Is that right?
The best place to connect with me is multifamilyu.com. So I am very passionate about teaching people real estate intelligence, right? So people talk about financial intelligence. This is real estate intelligence. And so each year I bring speakers like Ingo Windsor, the CEO of Local Market Monitor. There's a lot of speakers. The CEO of Inodo comes in. He has amazing underwriting tools that are phenomenal and give you amazing insight to marketplaces. So I bring in these speakers, and I speak myself as well, 100 webinars a year, completely free. None of them are pitchy. You'll notice that there's no pitching allowed on the multifamilyu.com platform. And you know what's cool? Over 50 of them have nothing to do with multifamily. They are agnostic, right? They're just real estate webinars. So multifamilyu.com is perfect. You want to send me an email, it's Neil, it's Neal, the Irish spelling, Neal at multifamilyu.com.
Awesome, Neil. Well, it's been my great pleasure to get to know you and to have you here on the show, and I can't wait to have you back where we will talk market analysis for this year and beyond. Thank you so much, Neil. I appreciate it.
Awesome. Thanks for having me on the show, Clayton.
You bet. And thanks to all of you for downloading and subscribing and pushing us up to the top of the charts. We really want to say thank you we just passed the 14 million download mark. So much love to all of you, and much love to all of you for sharing this with anyone in your life that you would want to build financial intelligence. And financial intelligence doesn't just stop there. We go into real estate intelligence with great guests like Neil, who was just here on the show. Now go out there, take action, become a real estate investor. I believe it's the number one way to build wealth. Even if you need to start with building a campus as your first real estate deal, it can be done. We just learned about it. We'll see you next time, everyone.